Well, the party just about to go down in Times Square as stocks keep going up. Wall Street closes out a huge year with yet another record. Will this party continue in 2014? We are all over it. Welcome, everyone. I'm Charles Payne in for Neil Cavuto, and this is Your World. And break out the champagne because Wall Street has plenty to cheer about. As stocks cap off the year with huge gains, the Dow surging 26% this year. And count them, 52 record closes in 2013. It's the Dow's best yearly performance since 1996. The blue chip average now up for 5 straight years. And the S&P 500 also finishing out 2013 at a record high. It's up more than 29% for the year. And the Nasdaq, well, it's not a record finish, but a hefty 38% jump for the year. And that's the largest percentage gain for the Nasdaq since 2009. And we're all over it with Lauren Simonetti at the New York Stock Exchange with the standouts for the year. Stock trader Teddy Weisberg with the mood on Wall Street. Market watcher Robert Prechter, who says this boom is about to go bust. And Scott Martin, who says Obamacare could be a big reason why. But let's begin with Lauren.
Hi, Charles. Yeah, what a year it was. Let me give you the final numbers. And, of course, we're still closing out. The Dow up 72 points today, closing off the highs. But it's 52nd record high in 2013. Haven't seen that many since the year 1995. Let's take a look at the Dow 30. You can see the top 30 performers this year. Boeing up more than 80%. American Express, the new member, as well as Disney, all up more than 50%. Out of those 30 stocks, there's just one that's down in 2013. It's Big Blue. IBM down about 3% this year. Tech stocks putting in a strong performance today and certainly this year. Facebook has more than doubled. Talk to Teddy Weisberg about that. That was his pick for 2013. We thought he was crazy. Not anymore. Hewlett-Packard almost doubling this year. This was the #1 loser on the Dow last year. No longer part of the Dow. Definitely a winner this year. Also, Google, of course, it hit $1,000 back in October. A lot of people are trying to figure out why this rally. It almost seems like a very hated rally, Charles, right? Low participation and things like that. But with the Fed and the easy money policies continuing, yeah, there's been room to grow and the stock market has been juiced. I want to leave on one final point, and that's where interest rates are going in 2014. We did see the 10-year hit 3%. We have housing sales very strong. If you look at new home sales, up more than 10% this year. And existing home sales, that's the bigger part of the housing market, those are up more than 9%, Charles.
All right, thank you very much, Lauren. Now, I want to go to Teddy now because not only did Lauren mention that this was something of a stealth rally and a hated rally, but it caught a lot of the experts on the floor by surprise, Teddy. So how are you feeling about the rally, the legitimacy of it, and how are you looking for 2014?
Well, I mean, it's been a great year for Seaport and our clients, and for us with our own portfolios. We basically, Charles, have stayed long all year. I would agree. I'm not quite sure why the market's done as well as it has, but it's been a mistake to fight the tape this year. Any sell-off with the benefit of 2020 hindsight clearly has been a buying opportunity. But the trick this year was just to come into the year long and stay long, and that's just what we did.
Yeah, but Teddy, Lauren mentioned that you like Facebook. Now, I wouldn't imagine you to be a Facebook kind of guy, but I guess you are. So you did more than just stay long. You also picked some things off the bottom.
Well, I mean, I've been doing this a long time, Charles, and you and I have kind of been jousting about some of these issues for many, many years, including the price of stock exchange seats going back to 2006. I mean, we're contrarians, and we're still long Facebook. And if you ask me what my stock of the year is for next year, I would pick Facebook again. But speaking of being a contrarian and looking forward into 2014, we're concerned that the big risk in the market is not that we continue economically and fiscally as we are, but that the Fed gets caught flat-footed and the economy and interest rates really start to shoot up a lot faster. And that's the big unknown for the market. But if that's not the case, I think it's basically hold the course. And the one contrarian move we made, and we are obviously long these stocks, we bought all the golds today.
All right, well, I got to tell you, a lot of people say that definitely is going against the grain. Hey, Teddy, you have been amazing. That's why you've been down there for so long. Happy New Year, buddy. We'll talk to you again real soon.
And Happy New Year to you and all your viewers.
Hey, and it's around the globe we go because they're already ringing in the new year in Dubai, New Zealand, Australia, and in China. And for investors, well, there's plenty to cheer about everywhere. Markets in Britain, France, and Germany rallying between 14 and 25% for the year. And that despite austerity measures kicking in to tackle their huge debt problems. Over in Asia, where Japan was a standout in that region, the Nikkei average rising 57% for the year. You can thank Prime Minister Abe there. Hong Kong was also up, not nearly as much in China. Well, they bucked the trend, posted a nearly 7% loss for 2013. And as this rally, well, is it about to come crashing down? Because if Robert Prechter is right, this dramatic run-up in stocks is about to come to an abrupt halt. While the man whose Elliott waves accurately predicted the 80s boom is saying to get out now. And he joins me now in this exclusive interview. You know, Robert Prechter, you've got an enormous reputation on Wall Street. For a long time, you could do no wrong. More recently, you've been called a perma-bear. Why are you going to be right now?
Well, first of all, I'm glad to see that somebody else is working on New Year's Eve.
I got dressed for the occasion, too.
Yeah, so did I. At least from the waist up, you know, that's how you do it on television. Yeah, you know, the Investors Intelligence poll, which does a weekly poll of investment advisors, has just reported the lowest percentage of bears in over a quarter of a century. So I figured, well, you know, it's about time. I haven't been on TV for a year and a half, and it's time to come out and I think represent that camp.
You know, in 2003, Robert, you made a prediction that the world stock markets would drop 90%. Now, you're not one of these simple pullback correction guys. When you say we're going to drop big. Give us a worst-case scenario for 2014.
Well, first thing I want to say is I think that we are within 0 to 3% of the high for the move up from 2009. So it's getting very, very old. I think 2014 is going to not only be a down year, but a very large down year. This is a very extreme minority opinion. There was a major newspaper that just did a poll and got a whole lot of Wall Street strategists together, and they couldn't find a bear. The most bearish person said he thought it would go sideways.
Well, I got to tell you, Robert, let me just jump in for a moment, Robert, because I know everyone that comes on Fox Business is a bear. I know a lot of bears. Now, what distinguishes you? I mean, what are you looking for? I want you to tell us what's the worst-case scenario on the downside for next year.
First of all, I want people to understand why I've got this opinion. In 2000, we had record sentiment readings in terms of optimism. In 2007, we had the same thing. We are now seeing for the third time, and I don't think very many people expected that, extreme manic-type sentiment readings. Let me just give you a couple of quick ones. There's a weekly poll of active investment managers. They usually say they're 80% invested, 90% invested, or whatever. For the first time ever, they've reported a 104% invested. That means they've got more money in the market than they have under management. That means they're borrowing a bit. And the Ridex funds, you know, people can buy not only long and short funds, but they can buy leveraged funds. They can be 200% long or 200% short. When you look at the amount of money in the leveraged long funds, right, it's 12 times what it is in the leveraged short funds. As you also know, margin debt is at a new all-time high, and I think that's masking some of the debt that the public is going into because they're buying some of these leveraged funds.
You're just saying there's too much giddiness to the point where people are borrowing, professionals are borrowing money to go long this market, and even individual investors are borrowing. So we've set up the perfect storm for the perfect crash, which would land us where?
That's half of the perfect storm. The other half is the upside momentum in the market is actually slowing. Not many people know this because the momentum of optimism is increasing so fast. But if you work a 26-week rate of change on the S&P and the Dow,
Robert, we've got just 30 seconds
upside
left. The Dow is up 72 points. We're at 16,570. The market's rocketing to the upside. You are known for your bear calls. Please give us a downside target for 2014.
All right, we're within 3% of the high, and I think in 2014, 2015, we'll take out the 2009 low in both the Dow and the S&P.
Dow at 6,600 or lower.
You got it.
All right, buddy. Hey, have a great weekend. Glad you dressed up, at least from the waist up. We'll talk to you again soon.
Take care.
All right. Hey, a new Fox News poll finds that 54% of Americans think the economy will be better a year from now. But with the healthcare laws, employer mandates set to kick in, Scott Martin says all bets are off. But guess what? Rick Unger disagrees. Scott, educate Rick.
Yeah, I'd love to, Charles. Okay, Rick, listen up. So here's what we know about the economy, Charles. Small businesses, wages, job growth drives it. And if you look at any recent survey, actually any survey in the last, say, 6 months, Small businesses don't like the ACA. In fact, 55, close to 60% of them say it's going to have a negative impact on their business. 1 in 4, Charles, small businesses are going to cut the coverage altogether and pay the penalty in 2015. There's also a thing called the 49er effect. And no, that does not refer to the team in San Francisco that's going to make a run in the NFL playoffs. The 49er effect of keeping the amount of workers in your company under 50 so that you don't have to get hit by this mandate. It's going to cramp hiring. It's going to cramp wages. It's going to hurt the American people.
Rick, you know, it's hard not to argue with some of these things. We've already seen the part-time moves happen. We've already heard the howling from small businesses, and they are the job creators.
Yeah, well, first, you know, I know I'm supposed to be fighting with Scott, but he is a buddy, and I got to say Happy New Year to him and his family. So Happy New Year, Scott. And please pass it along to your wife. Look, this is all hysteria. If you look at the numbers, and you look at what's really happening with small business, and you ask small business people if they're even aware that they're entitled to certain tax credits, they don't even know it. The fact of the matter is, many, I don't want to say most, but many of these small businesses are going to come out well ahead while being able for the first time to give health care to their employees. They don't even know it.
Rick, me think of thou protest too much.
No, it's just true.
I mean the most ballyhooed plan, the signature achievement of President Obama's presidency, and nobody knows about all the good things.
Well, actually, you'd have to admit, in fact, I've heard you say it, that's been a problem. The communications has been a disaster. This is where, you know, I have faulted the administration the most. They have not conveyed important things about this program. The tax credit is there. You won't disagree with that. You know it's there. It's there for small business.
Scott, let me get back to you, Scott, because from my point of view, watching this rally over the last few years, I've always felt that one thing that could derail it was the U.S. economy. Now, we're seeing some good signs there, but a lot of people feel the same way that you do. If we get even a hiccup on the small business side, all bets are off.
Oh, I agree, Charles. And I think to Rick's point, a lot of the small businesses still, because of the lack of communication, maybe don't understand the benefits because either they're not there or they're not being communicated. And by the way, Rick is very charming and disarming, so good work there. But listen, Charles, you know, if you go forward in this economy and look at where the jobs are going to be created, look at where the economic growth is, it's all in the small business arena. And they are scared out of their shoes about this mandate. So either something's got to be cleaned up, more communicated, or you're going to see more layoffs or them not wanting to hire.
Hey, Scott, real quick, before I let you go, I'm sure you heard Robert Prechter, very famous prognosticator. He's saying Dow 6,000 this year, 2014. What do you think?
Yeah, he almost put me in tears. I think he's absolutely nuts. We will see Dow 20,000 before we see Dow 10K.
I agree with
What? Oh, wait a minute.
I'm with Scott on that.
You're with him.
I was getting depressed listening to the man. I don't agree with him at all.
I tell you what, in this rare case of kumbaya, Happy New Year, both of you guys.
And
Love
to
you.
you.
We'll see you in
And to you.
2014.
Big hugs.
All right. Hey,